Hello, this is Michael Ball, Managing Director with Weatherstone Capital Management, and this is our January 2021 Market Outlook and Update.
Today, we're going to cover the most recent trends with COVID cases and deaths. Then we'll take a look at how the economy is recovering from the worst of the lockdowns that we had experienced last year. We'll do a follow-up on some of the election seasonality, and with the strong year-end performance, look at what that may mean as we move into 2021. At this time, when we've had a change in the political party in the White House, we'll take a look at how political biases can influence perceptions of the economy. And then we'll wrap it up with a review of some of the recent adjustments that we have been making in the investment portfolios, some that we are looking at, and a long-term view of the stock market and the reason that tactical investing can play an important part in the overall asset allocation. As we've moved into the flu season and the year-end holidays, we've seen a steady increase in both the number of cases and the number of deaths from COVID, as shown on this chart and the one that follows. This is certainly troubling. However, there are a couple of encouraging aspects. The first is that we now have multiple vaccines that have been approved and are being rolled out. This should help to put an end to the pandemic in the coming months. The second piece of good news is that even without the vaccine, the healthcare industry has done a much more effective job of treating COVID and reducing fatalities rather than where it was 9-10 months ago. If we go back and look at the prior peaks that we had seen in April, we see that on April 20th, we had a 7-day average of a little over 30,000 cases and a daily average of 2,240 deaths. And so the average probability of dying was about 7.5%. If we look at the same data as we get to December 31st, the 7-day average of cases was a little over 190,000 with an average of still a little over 2,400 deaths, or basically a 1.3% chance of fatality. The healthcare professionals have been doing a great job of improving outcomes for an awful lot of people with severe cases of COVID. And we do look forward to seeing the impact of the widespread vaccination and really starting to get this pandemic under control in the coming months. One of the most important indicators that we're watching is the rebound in jobs from the lockdowns that we had last year. As can be seen on the chart here on the left-hand side, we can see the growth in jobs over the past 20 years and the very abrupt drop from the COVID lockdowns. We've been able to recover about 55% of those jobs so far, but that growth has been slowing down significantly in the last month or two. Obviously, one of the key aspects to getting back to normal will be to get back to the prior peak in employment. If we look at the chart on the right-hand side, it shows the job losses by industry and then the recovery by those. And most industries have still yet to get back to their prior levels of job growth. We can also see that economic growth has rebounded in a similar fashion. As the chart on the right-hand side notes, 68% of our economy comes from consumer spending. And when a significant number of people don't have jobs, it has a substantial impact on the economy. The economic stimulus payments to individuals and the restoration of income for people getting back to work has been very helpful in supporting the economic recovery so far. And the additional stimulus that we may have, as well as the vaccines being rolled out, should help to continue to build us back to prior levels of economic growth. Speaking of the government response to the COVID crisis, the chart we have here shows how the U.S. has done relative to other countries. in terms of the total amount of support given, we're kind of in the middle of the pack compared to many of the other larger developed economies from around the world. However, this breaks down into two primary areas. The gray areas are more direct payments and things going to individuals. And in that regard, the U.S. has put in about the largest amount of any country around the world and relative to the size of its economy. Many of the other large economies from around the world, they've given greater levels of support, but they've done it more by loan guarantees and things of that nature, which don't necessarily relate to direct checks into the pockets of individuals. So when we look at the government's response so far, it has been quite helpful. And even though in some measures it's not as big as what other countries have done, it's been bigger than virtually anyone else in terms of getting money directly to the people involved. In our prior quarterly commentary, we look at the question of how does the stock market typically perform from the time of the election afterwards. We looked at through the end of the year. And what we showed was that typically it tends to be positive for the stock market, kind of regardless of which party wins or things of that nature. And so just to follow up on that, it was kind of interesting because even though it's been an almost historically unprecedented election in terms of some of the chaos that followed it and things of that nature, the actual return was quite a bit stronger than what the averages have been, and it's actually been the strongest post-election rally that we've had since 1968. So building on that, we wanted to take a look at what that strong year-end performance may mean as we go into the following year. While we don't have an awful lot of cases of strong double-digit gains in the last couple of months of the year, we have had 5 cases since the end of World War II. So for what it's worth, we will look at this, and it may give us a little bit of insight. And that insight does tend to be pretty positive for the markets. If we go back to the prior 5 cases and we look at the subsequent year, we find that in every one of those cases, the market was up, and it was up in the double digits with an average gain of a little over 18%. So while I would caution that a sample size of 5 is reasonably small, the information that it does give us does say it tends to be something that's positive historically. In the reality, there's going to be many other factors in terms of success or failure controlling COVID, other factors that go on that are probably going to have a bigger impact, but the strong momentum does tend to bode well for the new year. With the election now behind us, I also want to take a look at how our political preferences can color the way in which we look at the economy and many times the financial markets. This chart goes back and shows the percentage of people who rate the economy as doing either good or excellent over the past 20 years, and that number is in green. Then it also breaks the percentages out by those who are Republicans and those who are Democrats. And so if we look at the trends over time, if you look at the years in which you had a Republican in the White House, Democrats typically rated the economy as doing worse than what Republicans did. And then it would flip when you had a Democrat in the White House. Democrats became much more optimistic. Republicans became much more pessimistic. And so that's just a bias that has tended to be built into us, and it can oftentimes spill over into how we view the financial markets and how we may make some of our investment decisions. And so even though if our person may not be in the White House, we think that the people in there aren't necessarily going to do a good job, the reality is a lot of pieces of the economy move fully independent of that. McDonald's is still going to be making hamburgers. Coke's still going to be selling a lot of Cokes, regardless of who the president is and if it's from your preferred political party or not. And so as we look at that, we need to kind of, in a way, separate that from how we make investment decisions, because in a much more global economy and with businesses that are operating over investment cycles and different political parties in office, there's bigger and more important questions that can influence how we want to invest rather than is our preferred person in the White House or not. As we look at changes that we have made to asset allocations over the past several weeks, we've begun to see longer term interest rates beginning to move somewhat higher on government bonds. As a result, we've started to see some weakness in interest sensitive sectors such as utilities, real estate, and a little bit of consumer staples. We've moved some of those assets in a couple of our investment strategies out of those areas and increased weightings to current positions in gold, which would benefit from increased inflation, as well as to cash, just to build us a bit of a buffer while we're waiting for some better buying opportunities to come along. In terms of fixed income holdings, we've reduced some of the weightings to corporate bonds and a little bit in terms of some of the housing-backed bonds. And we've used that to increase weightings into floating rate bank loan funds, which we find quite attractive, both because they're selling at a discount of typically about 3 to 5% from face value, and from the benefit that they would receive if interest rates were to start to go up, if inflation picked up. A second area that we have added some money into are tax-free municipal bonds, which will become increasingly important to investors if tax rates are to go up in the future, as President Biden has indicated that he would like to see on higher income households. So those are two areas that stand to benefit as the interest rates are starting to push a little bit higher, and those areas are remaining pretty stable overall at this point. In terms of some future adjustments that we're looking at making, we're looking at potentially reducing weightings in large company stocks and reallocating some of that into smaller company stocks, which have largely fallen behind the performance of larger company stocks here over the past 2 or 3 years. But with the additional stimulus and things that's coming down the road, they have started to perform better and have quite a bit of potential room to catch up to large company stocks. In addition, we may also increase weightings to foreign stocks, both in developed and emerging markets, and we'll talk about that a little bit later on the next slide. In terms of for fixed income, we may look to continue to increase our allocations to floating rate bank loan funds, and depending upon what we see in terms of strength or weakness in the dollar, there's a potential that we may add to or begin to set some positions in foreign bonds, both developed and more likely in emerging market and corporate bonds. In prior commentaries, we've talked about the performance differential and the valuation differential between U.S. stocks versus foreign stocks, and I wanted just to come back and touch on it again because it is a potentially major theme that could unfold over the next number of years and be a very attractive place for growth-oriented investments. This chart goes back a little over 20 years and shows some of the trends of U.S. stocks in green and foreign stocks in purple. And so as we look at that, generally they've tended to trend together and have typically had similar magnitudes. But in the last 10 years, it's been significantly more focused on US outperforming relative to foreign markets. Part of that's been the dominance of technology stocks and the stronger growth that we've had in the US and favorable changes in tax rates. With some of those changes in tax rates potentially being reversed, there's a potential that we could start to see this trend shift and see foreign stocks play catch up with US stocks. As we've previously noted, I just wanted to update once again, when we look at valuation differences between US and foreign stocks are historically very cheap relative to the US. And as Jack Bogle, the founder of Vanguard, famously said, reversion to the mean is an iron law of investing. And so when we look at that, the fact that foreign stocks are staying as cheap as they have been is pretty unlikely to persist for an extended period of time. And so as we start to see that momentum rebuild, this could very well be a multi-year theme where we're able to see a set of meaningful outperformance by these foreign markets. In addition to the valuation differences, the growth differences, particularly in the middle class in the emerging markets, is going to be a potentially significant driver over the coming decade. The charts here on the left hand show the growth rates in emerging markets versus developed markets, which has been and is projected to continue to be quite a bit faster than in developed markets. But more importantly, as we look at the charts on the right-hand side, this shows the growth of the middle class in some of these significant countries. And so if we look at the two most populous countries in the world, China and India, if we go back to 1995, China had basically nobody that was considered middle class. They've moved up to 34% in the middle class currently, and that's projected to nearly double here over the next 9 years to being at 72% of the population by the end of the decade. Likewise with India, they went from 1% in 1995 to currently at only 17%, but they're expected to actually overtake China and be at nearly 80% in the middle class by the end of the decade. There's also going to be significant jumps in countries such as Indonesia, Brazil, and Mexico. And so as these grow, that's going to open up a lot of opportunities, both in the economies on those local countries and for the companies that can serve that growing middle class consumer. One final note on emerging markets is that if we look at the potential changes that we may see on inflation, it does tend to be beneficial in particular for this segment as well. So if we look at the four boxes that we have here, it looks at how different types of asset classes perform in different inflation environments. Currently, we're in a low and stable inflation environment. The likelihood inflation will fall much from here is not very high. So let's look at when inflation is low and rising. And in that environment, the two best performing asset classes tend to be emerging market equities and gold. Gold is something that we currently have in several of the investment portfolios. Emerging markets we have, and we're looking to bump those up. Most every investment class does well with low and rising inflation. If we were to see inflation pick up, and it's not necessarily high, but let's say we see that inflation moves into being high and rising, emerging market equities still continue to perform better than virtually every other asset class. So both from a valuation standpoint, from a demographic standpoint, and from an inflation standpoint, you have a number of positive tailwinds for foreign markets, and in particular for the emerging market stocks. Finally, I want to share a chart that really sums up why tactical money management is important. This is a chart that goes back roughly 120 years, and it has some lines showing what are frequently called secular trends, where during some periods stocks can make significant moves higher over a number of years. And then at other times, you can see that the stocks lose, and basically you have a number of years, sometimes even decades, where stocks are going sideways and not making any real headway. If you have a long enough time frame, you're going to experience both types of markets. And that's fine when you're a younger investor and you're building your retirement nest egg and you've got a lot of time to let the financial markets work for you. However, when you retire, the difference between being in a market that's trending steadily higher versus one that drops and takes a number of years to recover can have a very significant impact on your finances during retirement. With most retirees needing to plan for a 25 to 35 year time frame in retirement, if the future is anything like the past, you're going to experience both kinds of markets. In a rising market environment, tactical investment strategies tend to be a little bit more of limited benefit because they tend to look at things from a risk first perspective, and sometimes that means you miss out on some market gains. But during sideways or down market periods, the flexibility to not always have to be in stocks, to be in cash or other defensive areas, and to try to invest only when taking on risk has historically been rewarded, can be a good strategy to help minimize some of the potential long-term drawdowns that can occur in these types of environments, and still be able to help you earn enough return to maintain the lifestyles you want to have, to reach the financial goals and things of that nature that are most important to you. So in summary, the economy is continuing to rebound. We're seeing generally good news on the COVID front, with vaccines now starting to get distributed, and hopefully a significant reduction in the number of cases and fatalities now in front of us, and being able to move back to a more normalized economy. We're seeing some positive trends for the financial markets, with the end of year strength that we had seen back at the end of 2020, and the additional stimulus that is expected to come from the new administration. As we look at different areas in which we may invest, we're starting to see improved momentum out of foreign markets, which could be the beginning part of a longer term trend there, starting to outperform the relative performance of the United States. And then, as we look at things in terms of a long-term picture, we'll have good cycles, we'll have bad cycles, and having flexibility to adapt to what we have out there and looking for opportunities is really, in my opinion, the thing that's most important in being able to reach investment goals, because there's enough things that will change and happen over time that we didn't expect. And if anything, 2020 was the prime example of that. And so, without needing to try to predict exactly how the future is going to unfold, we just need to be flexible and be willing to adjust, and doing so can really help us to adapt to what markets can give us down the road, and to make sure we can keep financial plans on track. With that, I hope you have a great day and look forward to visiting with you in the coming months.